Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. What a week this last week was. It Volatility is probably an understatement for what we saw last week. Just as kind of a review, as of last Tuesday, so just almost a week ago, Tuesday marked a 4-day decline in the markets, where the S&P 500 was down about 12%. A lot of nervous people, a lot of things on TV, a lot of news going on out there, a lot of political things going on. Most of that was due to tariffs and the uncertainty of what's going on with tariffs and what's going to happen with those going into the future. On Wednesday, there was an announcement that tariffs were going to be delayed for 90 days while they're working through some of these issues with other countries. And the markets rebounded by 9.5%. So not all the way back to what they were, but we got a good chunk of it back. That 9.5% increase was the largest one-day increase we've had since 2008. So to say that we've had volatility is probably an understatement. Where does that leave us? It's very, very interesting. We've had a lot of calls and we've talked to a lot of people that are wondering. We've had some people that are very nervous. Other people are calling, wondering if there's some opportunities to buy out there. And our answer is yes, it is unnerving that the markets are going up and down, but we feel like our portfolios are very diversified and we feel like we're positioned in a good place. So I just wanted to share a couple of numbers. It was not just the stocks that were in trouble last week, but the 10-year treasuries lost about 10 basis points earlier in the week, and by the end of the week had gained about 47 basis points. So it wasn't just stocks; it was bonds as well. So the graph I wanted to share with you today is really looking at 60-40 portfolios, which is kind of a middle of the road portfolio, not real aggressive, not real conservative, but kind of middle of the road portfolio. And as people have wondered, am I better off just pulling my money out, putting it in cash right now, or am I better off just to stay in my portfolio? So I just wanted to share this with you. This is a chart that shows how a 60-40 portfolio has performed on a 1-month basis, a 1-year, 3-year, 5-year, 7-year, 10-year, and a 13-year time frame versus the markets. Versus pulling your money out and putting your money in cash. And what the numbers tell us is a diversified portfolio, having a portfolio that's got both stock and bonds in it, and again in that 60-40 mix. On a 1-month basis, the diversified portfolio outperforms a cash position or pulling your money out and just sitting on it about 65% of the time on a 1-month basis. And obviously, the longer that you stretch that out, the better it gets for being diversified. So on a 1-year basis, it's up over 80% or about 80%. You go 10 years, it's about, I think, 91% of the time you're better off. If you have a long-term perspective, you're better off being in the market versus being in cash. And over 13 years, there's never been a time where you're better off being in cash than being in a diversified portfolio. And I would say even more than that. This is just looking at a 60-40 portfolio, 60% in US equities versus 40% in bonds. I would say that the numbers are even better if you have international exposure as well. So our philosophy is, yes, the fluctuations in the market are unnerving, but we still feel like we have positioned our portfolios to weather the storm very, very well. And those who are patient, we've always gotten through these before, and these numbers go back to 1995. So if you think about what that includes, since 1995, that's the tech bubble. In 2000, 2001, it's 08, 09, it's COVID, it's everything. So we've seen this before. Doesn't make it feel any better as we're going through it. But if taking the emotion out of it and looking at it, we've been through this before, and we feel very comfortable staying in the markets right now, staying diversified, and we think that you'll be richly rewarded for doing that. Just a couple other things. Interest rates have crept back up again, and it's very interesting to watch what's going on with interest rates. The other thing we're watching very closely is what the Fed is doing. As of right now, we don't know what the Fed is doing as far as cuts for later this year. We still anticipate there will be 1 or 2 later in the year, but probably nothing until June or August. But we'll continue to watch that, and we'll continue to watch what's going on in the markets and the underlying fundamentals in the markets, and we'll continue to report those in these weekly webinars. Again, we're grateful that you join us for these. If you have any questions, please let us know. If there's anything specific you'd like us to address, we're happy to do it. Thank you.